Hi guys, so in today's session we're gonna learn about fair value gap or fair value. So fair value is when a price between a bar and the next open bar, that price has not been traded back through, we call that fair value. So let me explain what fair value is. So for example, just on a general note, I'm not saying that is exactly what it is, okay? So for example, this close bar, okay, this green bar here, up to that, from that wick to this wick, that's a fair value gap, okay? That's a fair value gap. The price will likely trade back to it, but we are on a 4-hour chart, so of course we might see different price action. So this one over here, there is no fair value. There's a very tiny one, but it's very, very, very tiny, so I would not consider it. I would consider this one, but this one is a sell side imbalance and buy side inefficiency. So when I drag this one all the way down, it doesn't signify to me that it is going all the way down, because we already took in the stop runs, which we have discussed about in the order blocks. So in order blocks, whenever we have a stop run and there is a bullish order block, price will be going higher. So how we can understand this fair value gap is that it's not always signifying that a price should go down, retrace from the 50% and go back downwards. No, it can also signify that this is an inverse fair value gap. So how does it confirm that this is an inverse fair value gap? We see price trade extremely bullish through this when it is a downside candle, when there's a fair value gap. So it trades extremely bullish. So this whole thing is a liquidity void. So what the market does usually is that it tries to close those fair value gaps. It tries to close them off. And if it doesn't, and it is a bullish, just like over here, so it trades back through it. It uses this inverse fair value gap. It trades back through it, and then it doesn't even pass the 50%, and then it continues back upwards. So the fair value gap can also be used as a method of entry. So what we would enter is that maybe we put an entry at the 50% and a stop loss below that fair value gap, or we enter from the high of this fair value gap and we consider that the price can actually move all the way to the 50%. Okay, so our stop loss will also be at the bottom of this fair value gap, but our range, okay, is quite deep. So what we do is that we wait. Once the price trades through it, okay, we wait for this candle, okay. Once the price trades through it, I don't know how it's dealing, price trades through that fair value gap. As soon as it's going back up again, I try to take a trade maybe at this bottom or at this top here, at this high. Once I initiate that entry, my exit would be probably at this candle low here. This is only for short term. I like to scalp using this fair value gap when it is in an inverse and there's like a retracement of it. So I like to do like a short term trades, like 1 to 2 of this bar here, which seems like a bullish order block. So I'd like to take twice of that size whenever there's a fair value gap below. Okay, moving on to the next session. How do we target them in the daily? So in the daily, we come to see that there is a fair value gap that is presenting itself over here. Okay, so there's a fair value gap, a small fair value gap that is over there. Price will tend to close this fair value gap soon in the future. I'll just extend it. So we already have seen price move in a stop run, right? So what did I say? So there's a stop run. So now we might try to expect that there is a bullish order block forming within this area. So after this price point here, I expect this down close candle over here to be followed by a bullish candle, okay, piercing through it all the way to this volume imbalance. And what I want to expect is that price will appreciate that there is a bullish order block here, and will formulate that idea, and it will close even higher. So I am bullish on gold because the stop runs have already been taken, and I'm expecting it to perform an order block here to take us up higher all the way to this fair value gap, close it off, and perhaps maybe even take these highs and all-time high. So for the fair value gap, we can use it as a reference for targets, and we can use it as a liquidity void that price is not balanced, okay? That there is no balance in price here. That's how I like to use it. And whenever we want to identify, there's another type of fair value gap. For example, here we have this gap, okay? This gap is presenting itself. So we take it from the body, okay, all the way to the wick, like that. Okay, we consider it from the body. We don't consider it from the wick, okay, because there is a gap. So we consider it from the body all the way to the wick of the next candle. Okay, so this is another type of fair value gap. As you can see, price rejects cleanly at the 50% and sends itself even higher. Okay, cleanly rejects it, goes up higher, and we can see that on the candles next to it, it keeps going up higher and higher, and then suddenly it closes. On the next days, it closes those fair value gap. Price trades back through it after it closes. Price trades in the opposite direction. It goes upwards. Why? Because it created equal lows. Usually when price creates equal lows, which I don't like to reference this as a trade opportunity, I would like it to confirm to me the trade in the lower time frames as well. That whenever it does this equal lows or equal highs, I wanted to see a confirmation on the lower time frame as well, that it's trying to reverse or continue price action. Price over here dropped, so you got this liquidity that is standing over here. Now we're gonna expect a highly explosive movement upwards to take up these highs. We consider this fair value gap as our opportunity to trade. This is also a fair value gap opportunity to trade. I don't like to expand them, make them expendable, which means I want to remove those fair value gaps and not use them again. No, this is a higher time frame we're talking about. This has to be considered when we are trading on a day traders, okay? We have to consider these gaps. We have to consider the volume imbalance, this liquidity gap that it has left. Price jumped, okay, because there is a huge amount of sellers in the market at the point of entry on that day, on Monday. So there's a huge amount of sellers that made the price jump from the closure of Friday to the closure to the opening of Monday. So the closure of Friday is actually here at the top, but the gap that is persisting here, it's between those two bodies. We can see the wicks overlapping, but the bodies are not overlapping. So what I'm expecting is that it will run through this fair value gap, okay, completes its dealing with the fair value gap, enter this volume imbalance within this week, and then we could see prices even reach higher to this fair value gap. So this is the understanding of fair value gap, is that whenever there is a price between 3 consecutive candles, there is a gap, like there's no wick or overlap over the bodies, and there's an empty space the body has, that's a fair value gap. But we should consider, all right, just keep it as a note, we should consider the first fair value gap to appear, because not every fair value gap is a fair value gap, okay? So not every single time you see a fair value gap, you jump to it and say, okay, this is a fair value gap. For example, here, this is a fair value gap as well, okay? Over here, that's a fair value gap. So that's also a fair value gap that we need to consider, right? So there's a gap between the bodies, okay? There's a gap in the body here, it's not filled. So I take it from the body here, okay? This is the first fair value gap from this movement downwards, and this is the first fair value gap from the movement upwards. So that's how we need to consider it, because this makes like a short-term higher low, and then a higher high, and a short-term higher low, and then a higher high, and then we start to see a break of structure, okay? A lower low, and then a lower high, short-term lower high, and then a lower low, and then suddenly there's another market structure break. So that's how we do it. we just take the first fair value gap and treat it for our days. Okay. I don't like to use too many overlaps on the fair value gaps. The most recent one is this one. We can consider it, there's a gap between the bodies, so we take to the body of the candle. Okay, from the wick to the body of the candle. Okay, so let's consider this one for this week. Okay, and we consider this one as well, the most recent one as well for this week. We have the small fair value gap. So let's see, will price rally upwards to take this fair volume imbalance and the fair value gap 50%, drop downwards, or will it continue to take up the fair value gap that is above it as well? So this is how we identify fair value gaps and use them as a trading strategy. I don't like to use fair value gaps as an entry point because price wants to close those fair value gaps. They're like liquidity voids. To me, personally, I see them as a liquidity void. So if you want to trade it differently, you can do it. But whenever I see a fair value gap, I usually don't trade it. I see it as an opportunity of future trade that the price may go after or seek after. All right. It doesn't matter whether the gap has been made here and been left out. I don't want to use it. Okay. I don't like using previous gaps whenever the price is way too high. But if it is dropping down into that range and I see a fair value gap down here, I would mark it. But I don't mark it when I'm trading on a concurrent day or like when I see a stop run like this. So my main focus would be up here. I don't want to see price go downwards because it's already taken a stop run here. I want to see price rally upwards immediately. Let's go to the 4 hours. Okay. So on the 4 hours, we can see that this fair value gap that we have drawn is an accumulation of 3 candles here. We can see we refine it even slightly like that and take that to this gap there. Yeah, so that's a fair value gap, and then from this fair value gap we can see that there is a slight gap between this candle here, the one above. We can refine it as well. So we take it all the way there and we take it all the way down there. Yep. So that's the fair value gap. Okay. So price, the bodies did not close above this fair value gap, so we keep it in check in our future tradings. So this is the understanding of fair value gap. It's like a liquidity void that has been kept by the markets that will eventually pass through it in order to close it. So this is it. This is how fair value gap is and how we can use it. Whenever you see me referring to a fair value gap, this is what I mean by it. All right. See you guys next time.